Okay, welcome everyone. So I'm Pedro Matos, and we'll get started with our session, Firms and Corporate Political Activities. I wanted to thank our other co-chairs for the Academic Network conference, Caroline, Ayako, and others who will be walking as we start. Laura Starks was originally scheduled to be the moderator. I'm stepping in for her. But I also wanted to thank, again, Catherine, you'll be thanked throughout the day and tomorrow again, and Zoe and everyone at PI for all the logistics. So my job here is just to get us started. So we'll get started with the first paper, which is investing in influence investors and portfolio firms. And Eyub Yegen from HKUSD will be the presenter.
Perfect. Thank you so much. Thanks for having us on the program. It's a pleasure and honor to be here. And so today I will be talking about a project that we have been working for a while. It's on politics and institutional ownership. I think I can change the slides this way. No? Oh, perfect. Okay, so just to provide a bit of motivational information. So if you look into the institutional ownership patterns across time, we do see drastic changes. So if you look into the 1950s, institutional ownership on average was about 6%. But if you go to, let's say, 2017, this number actually changed quite drastically. Now we're about at like 65%. And in terms of concentration of ownership as well, this number has also quite drastically changed. I will be showing patterns between 1980 and 2016 that will also resemble a similar pattern in terms of this ownership concentration being actually much more severe now. And during the same time periods, if you look into the US political activities by US corporations, that has also been quite drastically changed. So US corporations are actually a lot more involved in the whole political process. They are much more active in the lobbying spectrum. They give a lot more money in the political action committee contribution domain. And also commenting on bills, for example, has been much more frequently appearing by these, let's say, corporations. So in terms of ownership concentration, so if you look into the patterns, there are these, let's say, large 10 asset managers. They have a large presence in US corporations. And this number is actually, some people think this is problematic. There's many benefits of it as well. I'm not going to go into the details of like whether this could be beneficial. The paper discusses this to quite an extent. But what I will be doing is that we'll talk about why this could matter, right? Why a large presence of asset managers could actually be important. So we know that institutional investors have a voting right. They have voting rights. And in some cases, managers may actually be very sensitive to these voting rights, right? In cases of, let's say, shareholder meetings, they might need those votes. And in return, they may cater to, let's say, these asset managers in some form. And what we are thinking of it is more that although it could be these potential cases where you have, let's say, asset managers being taken out for an omakase at masa at the expense of the company's profits or its revenues, this could be a bit more problematic, but we do think a bit of a more different angle of catering. What we are interested in is actually looking into the political catering sense. So what we have in mind is that when, let's say, an asset manager purchases a block stake in a public firm, does the public firm become much more aligned in terms of its political leniency as the asset manager does? This is of its own a very important question that we think. It's because of the political concentration or like the concentration of political influence in the US. We see that there's a quite drastic polarization in the US these days in terms of the political space. And these kind of processes, when you have, let's say, some elite institutions or asset managers that have a dominating power in the whole space, is actually problematic in a more democratic sense. It could undermine democratic processes. So what are we going to be doing in this paper? We will be investigating when there is a new presence of an asset manager, a block owner. Does the block owner actually use its economic power to translate into a political power? And then the second thing is that we will be looking into is which actually asset managers will be much more active in this space. We'll show that this is more driven by the active asset managers, so like more the hedge fund type of asset managers. And these are more partisan funds. And what are the mechanisms of actually amplifying the political voice? We'll be also looking into that. So what are the main results? We find that when an asset manager purchases for the very first time a large stake in a public firm, we do see that about 31% to 72% of an increase in the alignment actually happening in the post-acquisition periods relative to the pre-acquisition period. So this is quite large. Of course, there could be some sort of natural selection process, natural alignment processes, or like a selection-driven story. So think about like there's a Republican fund, and the Republican fund purchases a Republican firm, and there's a slow-moving convergence in terms of alignment. Maybe some of these results are driven by that. So to mitigate these type of endogenous concerns, we look into the setting where we just focus on random assignments, not random, but like quasi-random assignments into the portfolio of these asset managers. Specifically, what we will be doing is that we will be looking to the index inclusion cases. These index inclusion cases are very useful settings to understand when the asset manager not necessarily selects the stock directly, but it's just tracking the index, and then it suddenly has the stock in the portfolio. What do they do actually with this economic ownership? Do they translate it as well into political influence? And we do find similar results here. And then we actually look into whether the investors are adopting to the firm or the firm adopts to the investors' political orientation. And we find that actually the investors are very constant in terms of their political alignment. So they give to the very similar set of like politicians. But the firms actually do tend to change their set of politicians quite drastically over time, suggesting that it's most likely that the firms are adopting to the investors. And then we also look into if this is about investor preferences, is this about a strategic business motives or so. What we find is that it's mostly about investor preferences. This is also something we're right now working on to add a bit more context into this. But what we might find mostly is that these are like the privately held asset managers, very partisan, that are driving these results. In terms of mechanism, we find that board connections actually play an important role here. So if an asset manager has a board seat in the portfolio firm, the results are very, very strong. They're actually 3 times stronger than our main results. And then we have some additional results that we find. We document that Republican asset managers are actually much more active in the space. So they use their economic power to make the firms much more Republican. And the results are not driven by the largest asset managers. So BlackRock, State Street, or Vanguard are not the main driving forces here. And then we actually find some these are new tests, these are not in the paper yet, that around annual meetings, when the firm needs actually shareholder support, they tend to actually cater much more to these political preferences. So when, let's say, there's a lot more opposing votes in the past, and there's a new election upcoming, or there's some sort of like annual meeting where the shareholders' support is needed, managers actually cater much more. So results are much stronger in those kind of settings. And then we also see that this is most likely driven by personal preferences. We find that the results are very similar when we use, let's say, individual contributions of asset managers rather than the political action committee contributions of the asset management firm. The results are very similar. So it's most likely the fact that this is about a personal preference story of asset managers rather than some sort of like strategic gain story. And we also find that there's some concern that in this index inclusion case that the overall dynamics of the firm may be changing. So if you think about, let's say, the firms added into the index, now you suddenly have a lot less active ownership, and maybe the absence of active ownership can lead to some sort of change in the ownership structure or like the behavior of the firm, and that may be driving it. So we have been also controlling for these type of results to rule out some concerns like that.
Yeah, 2 minutes.
2 minutes, oh, perfect. I'm almost there. What are the implications of our study? This was a review by the Financial Times. They wrote this nice coverage on our paper, and they had this nice figure here. What they were suggesting is that these asset managers may sneak to the portfolio firms and say, hey, how about you start a PAC? And just use that PAC as a way to amplify our own voice. And so I just borrowed this in terms of just making the point that there are asset managers who will be actually using this as a way to make firms much more political. Is this a problem? So traditionally speaking, in the political economy, people have been always thinking that political action committee contributions or just political activities of firms was an extension of the profit motives of the firm. And what we find in this paper is that it's not just about profit motives. There's also some other non-pecuniary outcomes that may matter in these cases. And there are some societal consequences in this aspect. And what we find here is that this could be potentially troublesome for asset managers who are not active in this space. Why is that? So we have these cases where we see that when the asset managers actually are salient, and let's say they're very quiet on these topics, other asset managers can actually use this as an opportunity to amplify their voice even more when, let's say, everyone else is active in the whole process of voicing their concerns of what the firm should be doing. So what can we do here? We actually are opening a call for collaboration. This is something in Hong Kong that we are doing. We're always trying to have more impact on with our research. So the idea is that we are able to identify, for example, that there are some cases of, let's say, portfolio firms supporting some politicians that are actually not helpful from a profit motive. So it's actually shareholder value destroying from just even a profit maximization perspective. And we can actually point out and make some suggestions of let's say, what can be done and so. And BlackRock has some guidelines on this in terms of PAC contributions and the whole political activities. And we also point out towards those articles that BlackRock has been written. Thanks so much for listening, and I'm looking forward to the discussants' comments. Thank you.
Perfect. Thanks so much. So the first discussant is Dylan Miner from UCLA.
Great, thank you. So yeah, I've been at UCLA, currently at Columbia, bounced around a little bit. Delighted to discuss this excellent paper. So why do we care about this? As academics, we always start with this question, and there's a very practical reason of why we care about this as well. So here's a pictorial way to show that. So first of all, investors are giving money to their investment manager here, Fidelity, and then that company is investing the money somewhere, say General Motors, and there are some concerns. So one of them, and this is where a lot of the ESG backlash has come from, is some of these companies, these investment managers, are pressuring companies to engage in more, in the US context, we'd call liberal kinds of agendas, diversity, these kinds of things. So that's one potential concern, obviously not what they're studying, but you're going to see at the end, I'm going to tie this into that story. Then also, they're actually engaged in trying to potentially influence politics or maybe just express their personal political preferences, where both Fidelity and GM are giving donations. Now, in this case, I have, the former chair, Jeffries, and actually now also the former chair, it turns out, McCarthy, we just heard today as well, he's out, so I don't know who's in next. But the point being is that companies tend to give to both of these, whereas the investment managers, the Fidelities, are a little bit more concentrated. That's why we have one line there. What this paper really is about is it the case that when Fidelity takes a large ownership position in GM, is it the case that they're going to influence politics through that? That is, GM, the dotted line from them to the politicians is added. That's really the core question here. And of course, that's important because that would be another way that your investment manager is acting on your behalf, and you would care about whether or not they're doing that in a proper fiduciary standpoint. So how are we actually going to measure this? So really the whole paper is just comparing the dotted lines and trying to understand, you can't actually see the dotted lines, but to compare conceptually what's going on with the dotted lines. So how are we actually going to measure this? So one way to measure it is taking the log, I believe the natural log of PAC contributions plus 1, and then just looking before and after a 1% purchase, how are things changing? They also, in a clever way, look at divestment, right? Because if this does matter, once the investment manager divests of, say, GM, there should be a change. So they look at that as well. They also have scenarios where there's just simply an indicator. Typically, these companies are contributing to 35, 40 different politician funds, and just getting a sense of when they're acquired, are they giving to different ones from before? So just a 0-1. They also measure this also simply the percentage contributed to Republicans. So of all of their political dollars, what fraction is going to Republicans, both from the investment manager and GM, and how might this change after a large acquisition? And then there's also something else they call cosine similarity. Who's familiar with that in the audience, including the academics? Okay, 2 of you, fantastic. So I made this little slide right here because actually I think this is a brilliant way to, in one measure, collect a lot of interesting information. So this is the case of just 2 dimensions. So let's imagine you only invest in a Republican, only invest in a Democrat. You can see if you're investing in roughly half and half, we could actually draw, we call this a vector in academic land, what would represent kind of that allocation. But you could have another investor, they're giving more money to a Republican, looks like that. You could have another investor, they're giving more money to a Democrat in a symmetrical way, and we could measure that angle. Now, it's easy to see how that works in 2 dimensions. I'm not smart enough to do that in 35 dimensions, which is essentially what they're doing, but that's what the measure is. So to be clear, it's not measuring are you more Republican or Democrat, it is saying are you investing, if you will, politically in a similar kind of pattern. So it's a nice way to be able to answer that question. So what are the primary findings? So this is how I would actually summarize. So there's 10 tables. I didn't even see any of the new stuff, right? So we're at 25 tables. So what does all this stuff say? So really big picture for any of you practitioners in the audience is passive investors, because we find that passive investors have a larger percentage donating, and their main causal finding is actually essentially just looking at them because they're using changes in indexes, which then drive their investment decisions, not an active investor, to identify some effects here. So the big story here in my view is passive investors are influencing portfolio companies, that is the companies they acquire, to become more conservative in the US language, that is more Republican, often by joining their board post-acquisition. So that's an important mechanism, and that's also a super interesting finding to me. And as you mentioned, was it triple, quadruple, X, the effect when you look at that particular setting. So that's really yes, they're looking at active investors, all these things. That really right there is the finding. Now, a couple caveats. So the Republican effect, just as an example, a company goes from 48 to 50% roughly. There's different samples, and so it changes. Maybe it's 40%, 45, but whatever. It changes maybe by a couple percent post-acquisition. Also, how much money is, this is America, right? This is crazy land. Like, aren't they giving trillions to all these politicians? Well, the median, meaning half or more, half or left, is about $1,000 per politician. Now realize it is 35 to 39. The simple average is about $2,000, but depending on how you want to calibrate it, maybe it's a few $100, $500 increase over a 2-year period. So we're not talking about it's an increase in giving of billions of dollars. That being said, I think it still matters. So this does, though, suggest an intriguing story in the U.S. setting, in my view, that this could actually be what's going on. Passive investment funds publicly push companies to adopt more liberal policies whilst privately pushing them to promote more conservative politics. So if you actually put together their finding with what's in the popular media and the anecdotes, this is actually the precise story, and this is something that could be tested as well. So future research for you scholars out there. What are some suggestions for the paper? Again, it's already an excellent paper. They do lots of different things, so I chopped it down to 10, okay? Now the good news is you can do these pretty much with all, the nightmare for an academic is like, oh my gosh, I gotta go get more data, it's gonna be a nightmare. No, you can actually do this with pretty much everything you have, not even the new stuff, just the old stuff. So number one, I think would be helpful to justify the apparently the small effects, right? As you reference other papers and what have you, but to make it easy for us, like you could just calibrate some back of the envelope examples that this much of a PAC contribution leads to this, just to help us appreciate that it's not just a few $100s. This actually is a meaningful effect that you're finding here. Your sample size is 100 million, so of course you're gonna find significance. So the key is to help us understand that it is significant. Also, justify using the cosine similarity. We do have 2 people here you don't have to do that for, but I think it's an excellent measure. It's something that should be used more often, but it'd be nice to have a little more in the paper on that. This is super interesting. So last table, last column in the current version of the paper, the one that I reviewed, public pensions and endowments have a substantial negative effect. Everything's positive everywhere except there. And it's a big amount of money in the sample. So like, what's going on there? Something interesting. So I want you to find that out for us. Now, what if only studying passive investors? So it seems like a lot of the effect is coming from that, right? Looking at when there's an index, inclusion, exclusion, et cetera. And so it seems like that's most the effect if you just study passive investors. I think that would be interesting because it's a little counterintuitive. Normally, we just think it's the active investors are going to be active. What if studying, these are some different ways to cut your data that would be a little more simple. What if only studying total political contributions, total candidates you're actually supporting, and also presidential PACs? It'd be a lot easier to understand how does the allocation between 2 presidents change as opposed to 35 politicians in like 100 different districts, right? That would be a very easy way you could even lead with that. Herding, like when something's added to an index, there's like 10 different companies doing this, what's going on? And then what about all those zeros, right? So 93% of your sample, you're not actually studying because there are no donations. So something you could do, even a bit of a placebo effect, is have a look at what happens when a company that doesn't donate politically acquires a company that does. Does that company change, right? And that would be kind of interesting if that's the case. And then similarly, on the other side, the converse of that. And then lastly, Citizens United 2010, a sweeping change in legislation related to PACs, happens right in the middle of your data set. Right now, you just control for it with fixed effects, but it'd be interesting if there's something there identification-wise. So thank you.
Thanks, Dylan. So Lisa Hayles from Trillium will be the petitioner discussion. I'm already doing a bad job.
Not at all. Hi, everyone. Thank you very much for those comments of that very interesting observation near the end. So I'm going to try and summarize what I understood from the paper and then point out maybe some questions or areas of not even disagreement, but just like exploration. So Trillium is a sustainable and impact investment man. I don't have any slides.
No
but
slides.
No slides. Yeah. We are based in Boston. We have a 40-year history of shareholder advocacy and engagement. And we are very active on the issue of political lobbying and spending, meaning we intervene with companies to ask them not to do that. So this paper is very interesting, looking at kind of how investors may be intervening to amplify their impacts. So I guess I'm just going to summarize real quick what I understood. So the acquisition of a large stake in the firm leads to portfolio firms adopting the giving strategy, the political donations. Just to make sure I'm on the same page, and it's observed when investors buy a 1% or greater stake, and if there's a board membership, that increases the impact. And you're measuring political spending via PAC donations. And this is interesting because in the United States, a political action committee, a PAC, is actually employee contributions. And companies can also make donations from their corporate treasury to politicians or to super PACs, which are non-affiliated political action committees. And I think that's highly relevant because where we see as an investor the risk that potentially accrues to companies is often through their donations either to super PACs or to their donations or memberships in third-party trade associations. So that's where a lot of the most troubling or egregious behavior can arise. And I'll give you one quick example. So many of you will know that political spending has become a huge issue in the United States as a result of the Citizens United decision in 2010, which provided for unlimited spending by corporations as long as they're not formally coordinating with a candidate, a political candidate. And so what we found is that though the dollar amounts to individual politicians directly may be not very high, I think spending via super PACs and also via trade associations remains very elevated, and it's often hidden who the donors are to those organizations. So my example is Target and Home Depot. This happened shortly after Citizens United in 2011, 2012. And they're both headquartered, or at least have significant operations in Minnesota. They both donated to a super PAC called Minnesota Forward, which happened to be linked to a gubernatorial candidate, a candidate for governor, who was highly anti-LGBTQ. And their donations of $100,000 and $150,000 became public and created an enormous backlash, particularly against Target, which had a reputation as a kind of progressive, forward-thinking retailer. And so there was a national boycott organized by national LGBTQ organizations. So my firm, Trillium, and another firm filed a shareholder resolution asking both Target and Home Depot to do an analysis of the congruence between, because the other thing is that they'd made public statements in the past about their support for LGBTQ rights and their support for marriage equality, et cetera. So for us, the main risk as an investor is that companies will say and promote their positions on the one hand, and I think in exactly to your point, they will be funding something behind the scenes in order to advance other objectives. Because of course, I don't know if Target and Home Depot agreed with the anti-LGBTQ position of this gubernatorial candidate, and I actually think it's probably unlikely that they were pursuing other goals. And I think kind of taking a step back, so I will summarize that story by saying that both Target and Home Depot adopted oversight of their political giving as a result of the backlash that occurred. So I think the shareholder proposal was helpful, but it was part of the mosaic of factors that contributed to them creating this kind of oversight. So I think most investors, and this is the other kind of maybe point of not disagreement, but given that there's hundreds, thousands of investors in most corporations, I'm not really sure how, I work for a firm that invests in public equities. So we are always a tiny investor in the companies that we invest in. And I'm not sure how you could be sure to communicate your political preferences as an investor via your investments. That would not be your primary goal in my view. But I think you may be aligned in terms of your belief that you can advance certain company-friendly or shareholder-friendly activities via donations that can also blow up in your face as a result of activities like this anti-LGBT politician. So then what should investors do? So we think this corporate political spending is in theory designed to serve investors' long-term interests, but it's completely opaque. So, and that does not address another point, which is legitimacy. Should corporations be making donations at all? So we've basically taken two positions on this. Initially, we were looking for greater transparency and accountability. So having companies actually explain, how do you decide who do you donate to? What are the kind of policies and practices that are part of the oversight of this? And what my boss will say is that, yeah, we got better transparency, but their practices are still really crappy. So they're still indulging in donating to politicians that often support policies and practices that are incongruent with what they say. So, for example, in the United States, as you probably are aware, there has been a decision that has made abortion, that has restricted access to abortion. And many companies rushed out to say that they were providing support to their employees so they could access reproductive health services, but at the same time continued to make donations to politicians who are championing anti-choice practices and policies. So as an investor, we think this is a risk to the company's license to operate, to their ability to attract employees, to their essentially, we would like to see them ensure that they're, that's me at 8 minutes. We'd like to make sure that they, that there's congruence between what they say they do, what they commit to doing, and what they're funding behind the scenes. And I guess I will just summarize by saying, ideally, we'd like to see all political funding end, but with the current Supreme Court, that's probably not going to happen anytime soon. Thanks.
Thanks so much. So, Eyub, you don't have time, so
My apologies.
No worries. I think you got some great viewpoints from the discussion. We'll move on to the next paper. And Brayden King will present the socially responsible firms pay taxes. Also a very important question. And and floor is yours. There's a gentleman in the back who will tell you you're out of time.
Awesome. I see the lights too. So the answer to this question is no, not really. I'm going to show you how we get to that answer and also talk a bit about the heterogeneity, which I think is actually the most interesting part of the question, really kind of which of the firms are most likely or least likely to pay taxes. So I want to start off, what interested us in this question was really the recognition that this is a dilemma that we face in trying to solve the kind of the grand challenges of society, whether it be climate change or any other kind of systemic problem that the world faces. We have two kinds of solutions that we've developed to solve them. One is a more individualized firm-centric approach, ESG, CSR, kind of fit in that bucket where you try to punish firms that are bad, reward firms that are good, and then one by one kind of encourage them to adopt better policies. And then the other would be, trying to find public solutions. And I think we all recognize that there are certain kinds of solutions to systemic problems that really do require public intervention. So, for example, creating mass transit as an alternative to individual transportation requires public funding of mass transit. And if this is from a report of the International Monetary Fund, they recognize that the challenge right now we have with public investment in these kinds of solutions is that we just don't have enough money fiscally to do all this funding, at least especially in the United States, which is where we are going to focus our analysis. So to kind of give you a historical background of this, when corporate taxation was introduced in the early 20th century, there was a lot of public support for it. There was huge agreement amongst citizens and actually even in the business community that this was necessary. The president at the time argued that it's a privilege to be a business entity in the United States, and so taxation just is something that goes along with it. Early on, there was a conference held about taxation in which they argued that businesses were responsible to be taxed because they relied so much on infrastructure as a way to do their business, including having roads and railroads and things like that. And so most people agreed that taxation was good. It was not politically contentious to make that argument. But over time, the political agreement dissipated. It was partly mediated through the fact that there was kind of a new neoliberal view of economics that was sort of, diffusing throughout the political conversation, in which it was argued that the role of business is not to kind of look out for the public's interest, but rather to look out for their own interests. And that's how they serve the public interest, most famously put forward by Milton Friedman in this quote at the bottom here. And so what we've seen over time is that corporate taxation has been in decline. It's not as if these companies are breaking the law, but rather they are figuring out new and inventive ways to avoid paying taxes. And so since at least the 1950s, corporate taxation has gone down in absolute numbers, as well as a proportion of all taxes over time. At the same time, the sort of individual solution to societal problems has sort of been increasing. Visibility around CSR, ESG was increasingly called that, has been going up over time. This is just an example of an Engram plot of the terms corporate auditing or corporate social responsibility, massively increased after 1970 and continue to be a topic of conversation today. This sort of replaced public or fiscal responsibility as the main way of resolving the societal problems. So the question we ask is, are these two things kind of at odds, or is it possible to be socially responsible and also fiscally responsible and pay your taxes? One could argue that, in fact, there are three main stakeholders any firm has: owners, society, communities, and then the government. And one could argue that, one and two are kind of compatible in the sense that, you can reach win-win solutions by, developing socially responsible policies that owners or shareholders like. In fact, I think that's a lot of the argument behind sustainable investing. But it's not clear that investing in three is actually in either of the other, or it's not in one's interest, and although it may be certainly in two's interest, to invest in that stakeholder. So we just had a basic question, which is that, is there a relationship, association between CSR, being socially responsible, and taxation? And we are open to the idea that it could be no relationship. That is, that there's enough heterogeneity that it kind of wipes out the main effect. It could be positive if really socially responsible firms are also eager to invest in public infrastructure. They see a correlation between fiscal and social responsibility, or it could be negative if in fact high CSR firms sort of use that as a way to avoid paying taxes, or maybe if CSR is expensive enough that they have to pay fewer taxes in order to supplement their investments in sustainable practices and policies. And we are interested in the politics of this, in part because taxation is a political activity. It's politically contentious, as I laid out. And it may be that liberal managers or firms led by liberal managers are more likely to invest in CSR than firms led by conservative management. So just to give you an example of how this works out, I'll just lay out Apple here, which I think we agree is a company that's not known for being bad, although they have done things that have been questionable, certainly, in their supply chain. And yet they have a very complicated organizational structure that helps them avoid paying taxes. This is the main way in which corporations avoid paying taxes. They just create a lot of different holding companies, a lot of different units that are spread out globally, and they shift profits to the place where they have to pay the fewest amount of taxes. So if you don't have to pay taxes in, I can't remember which country it is, but one of these companies is based in that country, then you just shift all your profits there, and your effective tax rate is much lower than you would expect. And in fact, that is what you find, that despite the billions of dollars of pre-tax earnings that Apple makes each year, their effective tax rate is well below 1%. They're paying less taxes than many individuals do in the United States. So Apple is an aggressive tax minimizer. We won't call it tax avoider, but tax minimizer compared to other companies. Oh, we go back. So before I talk about the results, I'm just going to briefly tell you kind of the methods, how we do this. If you want to know more, I'm happy to send you the paper. We're looking at CSR using Asset4's ESG metrics. We actually do kind of a factor analysis to figure out to what extent do these things hang together. We're open to the idea that they are completely different versions of social responsibility. And we find that environmental and social ratings tend to correlate quite well, and so they represent one factor. And the governance factor is completely on its own. It's kind of a different form of responsibility. Not surprising, I guess, because governance is supposed to represent your efforts to be more responsible to your shareholders to a degree. And we then we look at the politics of management by looking at the share or the percentage of their donations that are given to Democrats versus Republicans. So if you're above 60% donations to Democratic candidates among management at that firm, you'd be more or less a liberal firm. If you're below 40% given to Democrats, you'd be more or less a conservative firm. And then we look at the interaction of ES and G with politics to see which firms are donating or which firms are paying their taxes. And to summarize this, I don't want to explain all of it, but we basically find that E and S don't account for anything. Once we do a fixed effects firm fixed effects analysis, the effect dissipates altogether. And importantly, in our random effects model, we find that that the effect is wiped out once you control for politics, or once you account for the politics, moderating effect on E and S. However, governance is consistently negatively associated with taxation, meaning that firms that are score highly on their governance factor tend to be lower taxpayers. We find that across all of our models. So this, I think, is the most interesting part of our analysis. If you look, you'll find that on the liberal side of the spectrum, firms that are high in E&S tend to pay more taxes. Firms in the middle tend not to pay any tax, or that is, their effective tax rate is no different than other firms. And then firms that are conservative and low on ES tend to pay more taxes. So you have two different types of firms that are paying higher effective tax rates: conservative firms that are low on ES and liberal firms that are high on ENS. So what does that mean? I'm just going to put the outliers here. The outliers are kind of the most interesting firms in our analysis. What's going on? On the one hand, you have companies like Symantec and Gap, which are both liberal and high in ENS. They pay a much higher effective tax rate than the average firm. And then on the other side, you have low ENS firms that are conservative, firms like Oshkosh, which is a defense contractor, and Wynn Resorts, which is largely a hotel, resort, and gambling operator that pay more taxes. So this is what we're trying to understand. We think there are two things going on. One is that liberal firms that are high in E&S tend to ideologically, they're okay with fiscal responsibility. That is, they don't want to not pay taxes. Whereas the conservative firms have to pay taxes because they're in industries where there's high regulation or where they're dependent on the state for their revenue. And so not paying their taxes would not be looked well upon by politicians. And so they end up paying their taxes for that reason. And that's where I'll stop. Thank you very much.
Thank you. So as in the prior paper, we'll have an academic discussion. Xavier Giroud from Columbia, go first.
All right, so thank you very much to the organizers for inviting me to discuss this very interesting paper. This one?
Go for the green.
Okay, perfect. All right, so let me start with a brief summary of what the paper does. The big picture question that the paper is after is the following. Do socially responsible firms pay more taxes? Now, from a theoretical perspective, this can go in any direction. Okay, so for example, it could be that socially responsible firms pay more taxes. Okay, this is what I call on the slides the good citizen hypothesis, essentially saying that those firms that are good citizen firms, they do not attempt to avoid taxes. It could also be that socially responsible firms pay less taxes, or it could be that there is just no relationship whatsoever between the two. Okay, so for each of those potential predictions, there are very valid theoretical arguments that can be brought. Okay, so the bottom line is that from a theoretical perspective, this is highly ambiguous. So therefore, this is essentially an empirical question that needs to be settled empirically. Now, empirically, what the authors do in the paper is fairly simple. Essentially, they regress the amount of taxes paid as captured by the effective tax rate from Compustat on some ESG metrics from Asset 4. And what they find is that firms that have high governance scores, they tend to pay lower taxes, consistent with the view that if you have good governance, essentially this helps you maximize shareholder returns. In contrast, they find that firms that have higher E&S scores, they tend to pay higher taxes, but only when their top management has a liberal political leaning. Okay, so that's in a nutshell what they do in the paper. All right, so in terms of this discussion, I'm going to focus on four main comments that I have for the authors. First, I'll talk about the relationship with the previous literature. Then I'll talk about firms' tax behavior. And then I'll have a few things to say about the identification and the empirical setup. So let me start with my first comment pertaining to the relationship with the previous literature. So the authors are obviously not the first ones to go after this question. Okay, there is in fact a very large literature on the topic. Okay, and to illustrate this literature, we can simply look at some of the titles of the related papers. Okay, so here on this slide, this is the title of the paper that was just presented. Do socially responsible firms pay taxes? Here's another paper, do socially responsible firms pay more taxes? Okay, recently published in the Accounting Review. Here's another paper closely related also in the Accounting Review. Here we can have another example, which is an article in the Journal of Biostatistics, and there are many other papers on the topic. So the bottom line is that there is a sizable literature on the topic. Now, this is obviously not a concern. If at all, this is actually good news, right? Because this shows that this is such an important question that a lot of people are paying attention to this question and are trying to bring answers to this question. Okay, so this is clearly not a concern. If at all, this is good news, and this suggests that this is really a question that is worth looking at. But that being said, even though I don't see that as a concern per se, what I would like to see is more discussion of the related literature. Okay, so currently in the paper, the authors do have a footnote when they talk a little bit about the different papers, but there they simply say that the evidence from previous work has been mixed and that the results tend to be all over the place. Okay, and this is something that is a little bit unsatisfactory because ideally what I would like to see is some discussion as to what explains these differences in the literature, and also why should we give more weight to the results in the paper. Okay, so do we have better data, better methodology, more informative sample, and so on. Okay, and so that would be my first suggestion to the authors, to engage more deeply with the existing literature and also try to reconcile the conflicting results. Okay, and I think the second point is especially important because to the extent that the results are all over the place in the literature, what this may indicate is that maybe there's just no robust relationship in the data. Okay, so it would be useful to get to the bottom of this. Then my second comment pertains to the firm's tax behavior. Okay, so in the paper, what the authors do, which is a very natural thing to do, is to look at this ETR. Okay, so this effective tax rates that captures how much money firms are paying on taxes. That being said, tax accounting is something that tends to be very mechanical. Okay, so there are very clear convention, and these are things that may not be directly at the discretion of the management. Okay, so one thing that might be helpful here is to also look at some other variables that would speak to firms' tax-avoiding behavior, but at the same time would be more directly at the discretion of the management. Okay, and so things that I have in mind in this context would be, for example, the amount spent on tax lobbying, or the fines that firms have to pay for fraudulent accounting, and especially tax-related fraudulent accounting. Okay, that would be my second suggestion to the authors, to consider a set of additional outcome variables that would be kind of more directly related to things that the management can easily affect, and also would speak to this tax-avoiding behavior. Then my third comment pertains to the identification and the interpretation. So here is a bit of a cheap shot, but obviously one thing that we have to worry about in this type of study is the endogeneity of ESG. Okay, so meaning the fact that there could be some unobservables that happen to be correlated with ESG, correlated with tax behavior, and that this could confound the results. Now, I'm obviously very sympathetic to the fact that it's not going to be easy to find a good instrument for ESG, but still in this case, what I would like to see is more discussion as to what could be potential confounds that could affect the results, and whether there are some tests that the authors could design to rule those out. Okay, and just to illustrate this point, here I have an example of a potential alternative interpretation that is in the spirit of this paper by Jovino, Martin, and Sovania. Okay, and what they show in that paper is that firms that pollute tends to pay less taxes. Now, even though this is something that is related to the paper and has the flavor of being about socially responsible firm and taxes, the interpretation that they provide in the paper is completely different and has nothing to do with ESG. Okay, so in their paper, this is all about asset tangibility. Okay, and so in a nutshell, the idea in their paper is that firms that pollute a lot tend to be firms that have all those big factories, okay, so that generate a lot of emission, and therefore have a lot of tangible capital. Now, if you have a lot of tangible capital, that means you have more collateral that you can use to get more debt financing. If you get more debt financing, you end up getting more debt tax shields, and at the end of the day, you pay less taxes. Okay, so that's sort of how they link high pollution with taxes. Okay, and so here this is just an example of a potential alternative story, where here what would be happening is that asset tangibility drives the relationship, but it's not directly related to ESG per se. Okay, and so my suggestion for the authors would be to think a little bit more about what could be potential alternatives, okay, especially given the endogeneity of ESG, and then try to rule out as many of those alternatives as possible based on on some tests that would speak to those. And then finally, my last comment, which is a bit of a technical comment, pertains to the empirical setup. So in the paper, the authors used the so-called random effect model. Okay, and this is a bit of a red flag because this is a method that is somewhat outdated in the literature, and therefore, it would be kind of nice if they were to use the fixed effect model instead, which is something they do in the appendix. Okay, and so here the reason why people don't really like the random effect method is because it's a method that is very restrictive in a sense that you have to make some structural assumption about the error terms. Okay, and it's something that totally goes against the spirit of modern econometrics, where essentially the model is that we just know nothing about the error term. In particular, we know nothing about whether the error term has a random effect structure. Okay, so if you don't trust my judgment on that, here you can trust Jeff Wooldridge's judgment on that question, who once said in a tweet or in an X that using random effects is like registering the level of guilt that you should feel for not using fixed effects. Okay, and that leads to my final suggestion to the authors. I would strongly recommend to use the fixed effect model in the baseline. I mean, currently they have it, but in the appendix I would just switch the two, which I felt would be more compelling in this context. All right, so that's all I have for the authors. So overall, it's a very nice paper, which is well worth reading.
All right, thank you. And our last person, Emma Pullman from BC General Employees Union.
Hi, folks. So thank you so much for having me here today. Thank you to Dr. King for that really important paper, and to PRI. This might be the only conversation at the PRI about taxation. And I hope next year we are on a panel stage talking about taxation, because there's so much interesting stuff happening in the world of taxation policy right now. So I am really excited to see a paper that is trying to, ask questions about ESG and tax activities. And, it's really exciting to be talking to practitioners in the space. So the organization I work for, the BCGEU, we are a long-term investor. We are an active investor. We care about long-term profitability, value creation, and market capitalization of our portfolio companies. We want to see strong alpha performance, and we believe that engaging our portfolio companies on ESG issues, including tax disclosure, tax transparency, protects shareholder value. And we also understand at the same time that we might also need to see some regulatory changes. So, tax responsibility is a systemic issue for asset owners. And even if some of the parts of our portfolio may perform better in the short term due to tax avoidance, tax avoidance is material and it presents governance, reputational, financial, and legal risks for companies. We need look no further than the Amgen case in the United States, where tens of billions of dollars were shifted to Puerto Rico to avoid paying taxes, and shareholders were not aware that there was a $10 billion tax bill. While the company was generating $26 billion, the average tax rate that the company was paying was 12%. So I'm going to shift to some conversation about the paper. So first of all, I really appreciated a history of the connection between CSR and the ESG movement, and there's even a history of the PRI in there for those who want to read the paper later. I think the paper touches on the transition from CSR to ESG as a way to standardize metrics, and societal concerns moving out of the hands of corporate managers and into the hands of shareholders. So my critiques on the paper, I'm speaking as a practitioner, as somebody who as an analyst is engaging directly with companies on these kinds of issues. So first and foremost, I had trouble gauging and assessing ESG performance on a broad scale, given the wide range of issues that fall under the ESG rubric. So, to give you an example, a company that has a strong ESG score and has a strong commitment to ESG issues will be affected first and foremost by the industry it's in, and then by the state of ESG concerns by stakeholders in its jurisdiction of incorporation, where its operations are conducted, the assets that it holds, where its shareholder ownership is concentrated, and many other things. A company that has a robust climate policy but has no human rights policy might have a really poor overall score, but it might have industry-leading scores on climate policy, for example. So I think that there are some challenges that I face with understanding the ESG scores in this paper, kind of so simply, because I think there's a lot of nuance there. And I think that, the other thing, and I think I reiterate a lot of the things that my colleagues said, ESG considerations don't always get embedded into every function or business unit at a company. So a company might have strong ESG performance, but ESG factors have no role in the company's performance, no role in the company's corporate or operational decisions or in its finance department. So the person who is making the decision to shift profit to a low tax jurisdiction is not the person on the ESG team. So, an example of a company with a strong ESG score, in fact, leading industry score that was praised for its approach to Indigenous rights was Rio Tinto, who subsequently went and destroyed priceless Indigenous caves in a scandal called Juukan Gorge scandal in 2020. It was legal for the company to do this. It had all the permits to do so, but the company took a huge reputational hit. and later on, even though the company had adopted the UNGPs, the company admitted that it had failed to incorporate ESG considerations into decision making. So I think we need kind of a more fulsome analysis. And focusing on the subject of political leanings of top management, I'm also kind of less compelled by this analysis. I think it's important analysis, and I want to see more analysis done here. But I think, as we saw with the other paper, I want to see more, maybe some looking at amounts spent on lobbying, amounts spent on super PACs, and other kinds of factors, because I think that there is probably some other issues to dig into there that we are not seeing right now in this paper. So ultimately, as a responsible investor, we want to see more public disclosure on a company's stance on taxes across all markets. We want to see governance in place that enables appropriate oversight of a company's tax strategies. And, that's what ultimately gives portfolio managers the information that they need to understand if companies are managing these risks effectively. I just want to say, we filed a shareholder resolution earlier this year. It is a company that also has a strong ESG score, a poor ESG score in terms of governance, but a high score in E&S. This is a Canadian company called Brookfield Corporation. This company, similar to this graph of Microsoft that we saw, carries out business activities through affiliates, which are incorporated under the laws of Bermuda, and also other tax havens. Analysis shows Brookfield being the kind of top tax avoider in 2021. So our proposal asked for a tax transparency resolution that allows us to. That's where the rubber hits the road for us. That's what we want to see, that specific kind of information. Rather than a percentage of a tax rate, we want to see it across jurisdictions. I'm very much running out of time. In its response to the proposal, Brookfield said to investors that they have all the information that they need, but investors obviously did not agree because in the first year, 28% of shareholders backed the proposal. We're starting to see, this is the strongest vote that we've seen globally for a shareholder proposal related to taxation, and certainly is not going to be the last. Looking ahead very quick, I see that I have to wrap up. There's so much exciting stuff happening on taxation. We've got FASB in the US, we've got mandatory reporting in the EU, we've got companies adopting the GIR standards. And then we've got the OECD Pillar 2 that's just come in, which is a 15% standard tax rate for all companies. It is cleverly designed, much stronger than Pillar 1, is going to set some, hopefully change the game, set incentives that will kind of shut down the use of tax havens, make it a lot less desirable to use them. Let's keep talking about tax policy. Thanks so much.
All right, thank you. Okay, so we got 3 minutes, and there's, I think it might be even better if we have some rapid fire questions from the audience, so you get more feedback. Any questions? Yes, just shoot your question really fast, to the point. Yeah. The microphone, sir.
It struck me that both issues were quite closely tied to preferences of senior management. One of the key issues I think that blocks engagement on some ESG-related topics is dual share class structures. And I wonder if more work might be done in terms of thinking about the obstacles that dual share class structures pose to constructive engagement on these sorts of topics. Thank you.
Perfect. And one more question, please. Yeah. Yeah.
Thank you. The question is, would the panel like to comment on the regulatory environment of pension funds, asset owners, that is, on their fiduciary duty to return, best financial return sort of concept? That seems to favour companies who actually avoid or evade taxes.
Okay. Anyone more? Right. So who wants to take it? Brayden, Eyub.
Well, I'll just say thank you for both comments. I agree with you that the regulatory structure is not designed to encourage people to pay or companies to pay their taxes. That's clearly part of the problem, which is probably why you see that relationship between governance and tax minimization.
Okay. I want us to finish on time, but there's really a lot of conversation going on here. So, and you could tell how passionate people were to squeeze in so much feedback. I encourage everyone to approach the speakers and the discussants to engage with them. My only role here to finish our session is to highlight that this is a network. So. Eyub said, for example, that we'd be interested in collaborating to get data to engage with folks, firms and investors. We also want to, if I can get the last slide up for just, you want us to join the academic network. Here's our, use this. And then also join us for the seminar series that continues the conversation throughout the year. So you can join us on this program that will be occurring online. So with that, my job was done. I was really very pleased that all of you made it here. And so if you wouldn't mind joining me in a round of applause for the people on stage. Thanks.